Welcome back to the Daily Crypto Roundup. Today's episode is a big one because the market has taken another sharp downward swing. XRP traders are still reacting to that long-awaited ETF launch. The UAE has set off global debate with a new crypto law that people are interpreting in completely different ways, and Bitcoin is back under $97,000 as liquidations sweep across the futures market. We've also got a surprising shift in sentiment coming from the Money 2020 conference in the US. One that suggests institutions might be a lot more bullish than the price action implies. And toward the end, we'll get into something that several analysts are calling one of the better buying opportunities we've seen in months, depending on how the next few days play out. There's a lot to get into. Before we dive in, make sure you're following the show. And if you enjoy these daily breakdowns, take 2 seconds to drop a 5-star rating. It helps more than you think, and it tells the algorithm that you want more crypto content delivered to you every single day. And as always, let us know what you think about these market swings. Are you buying, waiting, or sitting this volatility out? Let's ground everything with the top 10 coin prices right now, because nothing sets the tone like seeing where the money actually is. Bitcoin is sitting at $94,242, and the fact that it's under $97,000 again is what triggered a lot of this conversation today. Ethereum is holding at $3,176, slightly soft, but nowhere near panic territory. Solana is at $141.40, and to its credit, Solana's been surprisingly resilient. BNB is at $917, XRP is now at $2.26, and that one's a story on its own today. Cardano is sitting at 50 cents, Dogecoin at 15 cents, Avalanche at $15, Polkadot at $2.81, and Chainlink at $13.92. It's a sea of red across the board, but everything is red for different reasons, and that's where we're heading now. Let's start with the XRP situation because it's been the most emotionally charged story today. If you missed it, XRP finally got its long-anticipated US spot ETF, the XRPC fund launched by Canary. And, just like we predicted on earlier episodes, the price didn't explode. Instead, it fell. And this is exactly what we expected. Sell the news behavior. Early buyers taking profit, traders who positioned weeks ahead deciding to cash out market makers hedging. Anyone who's been in crypto longer than a few months knows the pattern. The interesting part is not the drop. It's who actually thinks this is a setup for the next leg. Crypto News had a technical breakdown this morning where analyst Dalmas Ngetich said XRP's structure still points toward a retest of the recent highs, as long as it holds the 220 zone. And over on CoinDesk, the CD Analytics team said the ETF launch actually sets the stage for what they called a potential reversal above 236, once the initial profit-taking finishes. Their exact words were that ETF flows don't show their real effect in the first 24 hours. They show up over the next few weeks as wealth managers and slow institutional allocators step in. Now, the reason XRP is down today isn't just the ETF itself, it's the wider market. And that brings us into the next big story. This wave of red across Bitcoin and Ethereum. Bitcoin's slide under 97,000 isn't random. Futures markets saw over $1.1 billion in liquidations, most of them longs, which means people were leveraged up, expecting a bounce, and instead got flushed out. These cascades trigger more selling, more stop losses, more forced exits, and it becomes this mechanical chain reaction. Ethereum followed suit, Solana dipped, and the entire market got dragged with it. But this is where the analysts are completely divided. On one side, you've got macro desks, Morgan Stanley being the loudest today, saying the classic 4-year cycle tends to have a rough fall season where Bitcoin retraces harder than people expect. They think this could continue for a bit. On the flip side, you've got on-chain analysts pointing at a number that's historically been extremely accurate, Bitcoin's NUPL ratio, which has dropped to 0.476. Every time we've hit similar levels, it marked short-term bottoms followed by pretty solid rebounds. CoinDesk even pointed out that exchange balances for Ethereum are now at their lowest level since mid-2024, which usually means accumulation, not fear. But before we dig deeper into whether this is a bottom or not, we've got to talk about the curveball coming out of the UAE, because this story blew up on Twitter and caused absolute chaos for a few hours. The UAE passed a new AML-focused digital asset law with extremely harsh penalties for unlicensed crypto activity. We're talking potential jail time and fines running into the hundreds of millions in dirhams. A tweet by Stani Kulichov, the founder of Aave, went absolutely viral because he suggested that this effectively meant the only Bitcoin you can own is the one the central bank allows. That phrasing alone was enough to send panic everywhere. But when lawyers and regional analysts dug into the text, a very different picture emerged. The UAE didn't ban Bitcoin. Crypto trading and custody remain legal. What the law targets are unlicensed service providers, the shady OTC desks, money launderers, and platforms operating without compliance oversight. If you're an individual using a licensed exchange, nothing changes. If you're a business running an unlicensed crypto service, you're in trouble. The nuance got lost in the panic, but once the clarifications came out, the tone calmed down significantly. We're going to take a pause for a quick break. When we come back, we'll look at what institutions are saying behind the scenes, why Money 2020 is signaling a major shift in US crypto sentiment, and whether this dip is actually the opportunity some analysts claim it is. Stick with us. We'll be back in just a moment.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
All right, let's jump back in, because the contrast between price action and institutional behavior right now is fascinating. And something else worth mentioning here is how different the sentiment is depending on where you look. Retail traders are glued to the red numbers on CoinMarketCap, but the deeper analytics platforms are showing something completely different. Whale clusters have been rebuilding quietly, especially around the $96,000 to $97,000 Bitcoin range, which historically has been a magnet zone for long-term holders. Glassnode's latest report shows a noticeable rise in coins held by wallets between 10 and 100 BTC. That's the bracket typically associated with early-stage institutional accumulation, family offices, and serious private investors. These aren't people who chase green candles. They build positions when everyone else is uncomfortable. And whether the market rallies immediately or not, that type of accumulation has always been the foundation of the next leg up. It doesn't make headlines, it doesn't trend on Twitter, but it's what shapes the next 3 to 6 months far more than any single liquidation event or panic sell-off. While retail is panicking and leverage traders are getting wiped out, the institutional world is acting almost like none of this red matters. At the Money 2020 conference in the US, which is one of the biggest fintech and payments events on the calendar. The messaging was surprisingly bullish. The conference president, Tracy Davies, said new US regulatory frameworks have put America back at the center of the crypto conversation, especially around stablecoins, open finance, and tokenized assets. Scarlett Sieber, one of the event's lead organizers, said the same thing. Institutions finally feel like the rulebook is being built instead of improvised one enforcement case at a time. Panels were packed. Tokenization was everywhere. Banks were talking openly about blockchain strategy. And a separate institutional survey from Signum found that 61% of professional investors plan to increase their crypto exposure moving into 2026. That's despite the volatility, despite the political noise, despite the ETF outflows, and despite a sea of red on the charts. This disconnect between price and behavior is something we've seen many times before. Institutions buy weakness. Retail buys euphoria. It doesn't mean they're always right. But historically, being on the institutional side of sentiment has been a safer place to stand. And this brings us to the last major storyline today, which is the debate around whether this downturn is a warning sign or an opportunity. And if you've been listening for a while, you'll know we don't do hopium here. We give you both sides and let you decide. On the cautious side, the technicals still show downward momentum. Bitcoin's trend structure hasn't fully stabilized, and we are in the season of the cycle where corrections deepen. ETF outflows don't help that narrative, nor does macro uncertainty around rate cuts. But on the optimistic side, the evidence for accumulation is growing louder. Ethereum leaving exchanges, Bitcoin hitting bottom range on-chain metrics, big wallets buying quietly, institutional surveys turning more positive, and even in the altcoin space, several analysts have started saying the same thing. This is where smart investors start dollar-cost averaging slowly, not aggressively, but consistently. And let's close with this. You don't need to pretend everything is bullish to recognize when the structure underneath the market is stronger than it looks. Yes, today looks rough. Yes, XRP didn't moon after the ETF. Yes, Bitcoin dipping under 97,000 looks ugly on the chart. But behind the scenes, the fundamentals, the regulatory clarity, the institutional interest, the ETF flows, the tokenization momentum, are far more important than a single red day. That's going to do it for today's episode of the Daily Crypto Roundup. Make sure you're following the show, drop that 5-star rating, and let us know what you're doing in this dip. Holding, buying, or just watching the chaos. Thanks for being here, and as always, we'll see you at the top.